Welcome back to the deep dive. It is February 2026, and I want you to just imagine two very different parties happening at the same time.
On the same street.
Exactly, right next door. At one house, the music is blasting, champagne's flowing, everyone is, having the time of their lives. That's the global market.
Mm-hmm.
But then you look inside your own house, the lights are dim, music's off, and everyone's just sort of sitting around checking their watches. That, unfortunately, feels like the Indian market right now.
That is a painfully accurate analogy. I mean, we are seeing a divergence right now that we really haven't seen in a decade.
It's wild. We've got a stack of data in front of us today from the Union Mutual Fund State of the Market Report, fresh for this month. And the headline number, it just screams at you.
It really does.
Global emerging markets have skyrocketed almost 40% in the last year. 40%. That is a life-changing return.
It is.
But then you look at India, usually the star of the show, and we were just flat.
Barely moving. And for investors who have been, conditioned to think India equals growth, this is a real splash of cold water.
So our mission for this deep dive is to tear this report apart and answer one big question. Is the party over for India? Is this underperformance a warning sign that the engine is broken?
Or is this actually the quiet before the storm? A massive buying opportunity set up by a potential game-changer event involving the United States.
Exactly. It is the question of the year.
And we also need to talk about a specific data point in this report that, honestly, it terrified me a little bit. It involves gold.
Oh, that gold number.
And it suggests that while the stock market is hoping for the best, someone with very, very deep pockets is preparing for the absolute worst.
We will get there because that number is staggering. But let's start with the global context. I mentioned that 40% figure. Walk us through that global equity market performance slide.
Sure.
Because looking at all these green arrows, it feels like we're the only ones not making money.
It certainly feels that way. If you look at the MSCI Emerging Markets Index, it is up exactly 39.8% over the last 12 months. In U.S. dollar terms.
A blistering pace.
It is. And it's not just the risky, high-growth countries either. The developed world is running hot. The NASDAQ is up 19.5%. Even Japan, the Nikkei, is up 35%.
So global capital is clearly in risk-on mode. They are throwing money at equities, which just makes the India number even more confusing.
Right.
So hit us with the reality check.
Here is the reality. The MSCI India Index is only up 1.6% in U.S. dollar terms over that same 12-month period.
1.6% versus almost 40. That is, that's not a rounding error. That's a massive underperformance.
And it gets worse. If you zoom in on just the last month, so January 2026, the index was actually down 4.8%.
Wow. So while the world was rallying, India was selling off. Why? We're usually the growth engine. Did we stall out?
It's less about stalling and more about, paying the bill for the party we already had. The report calls this front-ended returns.
Front-ended. Okay.
Think of it like a sprinter who runs the first lap at a world record pace. Eventually, they have to slow down to catch their breath. The other runners catch up.
So we priced in perfection a few years ago, and now we're just waiting for reality for the earnings to justify those prices.
Precisely. We are in a digestion phase. But there is a darker signal here, too. It's not just that prices are flat. It's that nervousness is skyrocketing.
You're talking about the volatility index, the VIX.
Exactly. The India NSE Volatility Index. It's basically the market's fear gauge. And leading up to February, the VIX spiked 44% in just 1 month.
Hold on. A 34% spike. That's not digestion. That's serious anxiety.
It is. When the VIX jumps that high, it means traders are frantically buying insurance. They're buying options. They aren't sure if the next move is up or down, but they think it's going to be violent.
Okay, so the headline index is flat and fearful. But as we always say, the market is just an average. If we look under the hood, there has to be a split. Someone must be making money, right?
Oh, it's a wildly split market. If you were holding the right sectors, you are laughing all the way to the bank. The clear winner is metals.
Metals.
The metal sector is up 36% year over year.
36%. Okay, that tracks with the global inflation narrative. Hard assets are winning.
Precisely. Commodities are a hedge, and they're flying. After that, you have the Bank X up 19.2% and auto up 15.1%. So the old economy, manufacturing, heavy industry, banking, it's holding up the fort.
But if the index is flat and these sectors are up 20, 30%, something must be dragging the average down. Hard. Who's the anchor?
The anchor is, surprisingly, a sector that everyone loves to love or loves to hate. depending on the cycle. Realty, real estate,
Wait, real estate is down in India?
down 14.7% year over year.
Wow.
And the scary part is the velocity of the drop. It plunged 10.3% in just the last month alone.
A 10% drop in a single month. For real estate stocks, that feels less like a correction and more like a crash.
It certainly suggests a sharp reversal in sentiment. I mean, a 10% monthly drop usually signals that investors are just fleeing the sector.
And it's not just real estate, right? Sci-tech is also in the red.
Yes, IT is down 12.7% over the last year, which is interesting because the NASDAQ, the global tech proxy, is up nearly 20%. Yeah. So Indian IT is decoupling from U.S. tech.
Which implies that the market thinks our IT companies aren't going to capture the same AI growth that the U.S. giants are.
Or it's a currency play, which we can get to. But looking at this, the fund managers behind the report, they are making some very specific bets.
So where are they putting their chips?
They're underweight on energy and utilities. Their reasoning is a weak demand environment, but where they have. Overweight is interesting. They like financials, attractive risk-reward.
Okay.
But the one that really caught my eye is the overweight call on capital goods, and they specifically reference the defense sector.
Defense. That feels like a very 2026 trade.
It's a cynical but effective trade. They mention significant underinvesting in the past as the rationale. It's a catch-up trade. Governments are rearming, and India is domesticating its production. That's a long-term tailwind.
Okay, so we have a nervous market rotating out of tech and realty and into metals, banks, defense. But let's pivot to that game changer I mentioned. Is there a white knight on the horizon?
There is one major item listed under key positives in this report that stands out above everything else. It explicitly mentions a much-awaited trade deal with the U.S.
Right, the U.S.-India trade deal. We've been hearing rumors about that for years. It always feels like it's 6 months away. But this report treats it as a serious, imminent catalyst.
They do. And more importantly, they connect the dots on why this matters financially. It's not just about selling more goods. The report believes this deal will catalyze interest of FPIs, foreign portfolio investors.
Okay, so let's break that down. Why does a trade deal bring in stock market investors?
Think of it like a credit score for the country. If the U.S., the world's largest economy, signs a major pact with India, it validates the economy. It reduces the geopolitical risk premium. Large pension funds in California or Europe feel safer parking money here.
So it just opens the floodgates for capital.
Exactly. But there is a technical benefit too. The report estimates that because of tariff relief, India's current account deficit could narrow by about 0.25% of GDP.
Current account deficit, that's the country's checkbook with the world. We import more than we export, so we run a deficit. Narrowing it is good.
Very good. And when you have a lower deficit, and at the same time you have foreign investors buying stocks, you have a high demand for the local currency.
So the rupee strengthens.
Bingo. The report expects a stronger Indian rupee as a direct result, and a stronger currency is a massive stabilizer. It keeps inflation down because imports like oil get cheaper.
And that explains why they might be bearish on IT. A stronger rupee is bad for companies earning in dollars.
That is a great connection, yes. The trade deal is great for the country, great for banks, but it's a headwind for the exporters.
Fascinating, but the deal isn't the only positive, right?
No. They also list things like last year's tax concessions, GST rate cuts, and they mention broadening welfare payments.
Putting money in people's pockets.
It helps consumption. But, and there is always a but that brings us to the risks. Because broadening welfare payments sounds nice until you look at the key risks slide and see the phrase competitive welfarism.
Competitive welfarism? That sounds like a polite way of saying buying votes.
It essentially is. It refers to the compulsion of coalition politics. The idea is that different parties compete to offer more handouts. You offer free electricity, I'll offer free water and cash transfers.
And the risk is this blows up the budget?
Exactly. It strains government finances and can lead to inflation. So you have this tension. Good welfare versus bad welfarism.
It's a fine line. And while the government walks that tightrope, there's a bigger storm brewing. Let's go back to that gold number you mentioned. Because when I saw this chart, I had to do a double take. Let's look at the commodity slide. Gold spot price.
Gold is up 75% in the last 12 months.
75% for a rock. A rock that doesn't pay a dividend, doesn't produce earnings. It just sits in a vault.
Just to give that some context, gold usually moves maybe 5%, 10% in a normal year. A 75% move is not an investment trend, it is a siren.
A siren for what? Why is everyone buying gold like it's the last safe thing on Earth?
Well, the report lists geopolitics will likely stay volatile as a top risk. Gold is the ultimate fear gauge. When gold goes up 75% in a year, it tells you that despite the booming stock markets, there is a deep underlying terror in the system.
Terror of what? War.
Terror of war, terror of currency collapse, terror of the financial system just seizing up. Big money sovereign wealth funds, central banks, they're hedging against something breaking.
It's a bunker trade. You buy stocks for the party, but you buy gold for the apocalypse.
Precisely. And it's not just gold. Look at oil. Crude oil is up 16% in just the last month.
And for India, rising oil prices are kryptonite.
It's our classic Achilles heel. The report explicitly lists any sustained rise in oil price can hurt India's macros as a key risk.
So that improvement to the current account deficit from the trade deal, a spike in oil could just wipe that out.
In a heartbeat. So we're in this massive tug of war. The trade deal is pulling us toward growth, and oil and war are pulling us back toward deficits.
It feels like the market is balanced on a knife edge. So let's bring this down to the actionable level. Is the Indian market actually on sale after this recent dip?
I wouldn't call it a bargain, but if you look at the fair value spectrum in the report, the Sensex PE ratio, we are still looking pricey.
Okay, give us the numbers.
The current price-to-earnings ratio is 20.5x.
And the historical average is?
17.3x.
So even after dropping, we are still trading significantly above the historical average.
Yes. The report classifies this level as the expensive zone. So if you buy now, you are paying a premium.
That's tough. You want to buy the dip, but the dip is still expensive.
However, there is a nuance here. The report has a breakup of returns table. Over the last 5 years, 86% of the Nifty's return was driven by earnings growth, not just hype.
Okay, that is comforting. It means the rally was backed by actual company profits. The foundation is solid.
Correct. But over the last year, the returns have been modest because the market is basically waiting for earnings to catch up to that expensive price tag.
So it's a waiting game. But while we wait, what about the safety net?
Right.
For people looking at that VIX spike and wanting to avoid equities, what does fixed income look like?
The outlook for fixed income is actually surprisingly robust, and it comes down to one number, inflation.
What's the projection?
It's projected to be incredibly low for FY26, just 2.1%.
Wow, 2.1%. That's basically nothing.
It's remarkably stable. And because the repo rate is at 5.25%, your real policy rate, that's the interest rate minus inflation, is very positive.
Right. So if I'm getting 5% in the bank and inflation's only 2%, I'm actually making 3% in real purchasing power. Savers are actually being rewarded.
Exactly. And the government seems to be sticking to its fiscal discipline plan. They're targeting a lower deficit.
Mostly.
Mostly. But remember we talked about competitive welfareism. There is another massive spending event coming up that the report flags. It's buried in the overweight rationale for consumer discretionary.
Oh, what is it? A hidden catalyst?
The upcoming 8th Pay Commission.
Ah, the Pay Commission. For our listeners who don't know, this sounds bureaucratic, but it's actually an economic bazooka.
It really is. It's a massive review that happens roughly every 10 years, where the government revises salaries and pensions for millions of central government employees.
And it usually results in a huge pay hike.
Huge. And often with arrears, a lump sum back payment. When this happens, it releases a massive amount of cash into the economy almost overnight.
And those employees go out and spend it.
Exactly. Historically, this has been a huge booster for consumption. Car sales, home appliances, you name it. It's a direct injection of liquidity into the hands of consumers.
So let's connect the dots. We have the Pay Commission coming, putting cash in people's hands. We have a U.S. trade deal coming, bringing foreign cash into the market. Those are two massive engines.
But we are currently sitting in an expensive market with rising oil prices and a massive spike in gold signaling fear. That is the landscape. It feels like a coiled spring.
So it's not a buy everything market anymore.
No. We are moving from a phase where everything went up to a phase where you have to be very selective. You can't just buy the index. You have to pick the defense stocks or the banks or the consumer stocks that will benefit from that Pay Commission cash.
And avoid the sectors getting hammered, like realty and IT, unless you have a very strong stomach.
Exactly. The easy money phase is over. The smart money phase is just beginning.
This has been a fantastic breakdown, but I want to leave the listener with one final thought.
Sure.
It goes back to that tension between the trade deal and gold. I can't get that contrast out of my head.
The handshake in the bunker.
Right. Think about what the market is telling us. On one hand, investors are pricing in a U.S. trade deal. That's a symbol of cooperation, integration, trust. It's an optimistic, sunny day bet.
And at the same time, the market has pushed gold up 75%, which is the ultimate symbol of isolation, mistrust, and the breakdown of the system. That is a stormy day bet.
It is a massive contradiction. You cannot have a world of seamless global trade and a world where everyone is hoarding gold bars. One of these narratives has to be wrong.
Or perhaps investors are just hedging. They're buying the handshake because they hope for the best, but they're buying the bunker because they fear the worst. The question for you listening right now is, which side of that trade are you positioned for? Because the market can't stay schizophrenic forever. Eventually, one side wins.
Handshakes or bunkers? That is a fascinating and slightly unsettling place to end. Thanks for taking the deep dive with us.
Pleasure as always.
See you in the next one.